This is the most common mistake between new smart money traders, not framing your trade idea based on the higher time frame or not paying too much attention to the higher time frame. As a general rule, the higher time frame will provide you the bias for the lower time frame setups. So let's say that we are currently on a 1 hour bullish trend like this, right? We are framing our idea based on a 1 hour order block that we might have here. And when price is hitting our level on the 5-minute chart, for example, we have a break or market structure right here, right? So the red line is the 1 hour chart and the green line is the 5-minute chart. After this break or market structure, we would assume that price is now ready to go higher because price is breaking the structure from a higher time frame level, in this case, the 1 hour chart. But what if the daily chart looks like this? Let's say that we have a daily bearish trend and it looks exactly like this. What is this telling us? That price is now coming from a daily bearish order block here. And now that it broke the structure to the downside, coming from this daily higher time frame order block, that means that this 1 hour swing here will potentially be broken. So the chances of price respecting these order blocks are lower compared to price breaking it because price is coming from a higher time frame level. And what if we look at the monthly chart and it looks like this? We have a swing high here, a swing low, and then another swing high on the monthly chart. This means that the monthly chart is bullish. And where is price coming from? It's coming from a bullish monthly order block. So that means that in this case, we wouldn't expect this low to be broken because now which is the target? This high. Every time price is coming from a higher time frame level, we expect lower time frames to be broken to continue the higher time frame bias. So, for example, on this daily chart, the target on this overall picture was to mitigate this monthly order block. Now that price is coming from this monthly order block, then the lower time frame 1 hour downtrend that we had is broken to the upside. So, the same scenario. Why would price break to the upside at 1 hour? Because we are coming from a higher time frame level. That means that now the daily is potentially shifting to a bullish trend. And if price, the last lower high was this one, then we can expect price to continue pushing higher and breaking this higher time frame. And based on this, we can expect this 1 hour order block to now, yes, potentially break on lower time frames and continue being bullish because the higher time frame has targets to be met. So you can see how the story changes if we are looking at the higher time frame. That's why it's so important. And when you are deep into lower time frames, you might be missing the bigger and more important story, and you might enter a trade that will hit your stop loss. People frequently ask me if they should be looking at higher time frame levels, if they should mark them, and my answer to that is relative to where price is now. Let's say that price is in the middle of a range, for example, on the daily move. We identify that this is the target for the daily, and we are right here. You don't care about this order block right here now because price has already displaced away from this level. So this level is not important now. Maybe the level that might be important is the order block here, as in spite of being a bullish move, there is probably going to be some kind of mitigation. So only if price is getting to this bearish monthly order block and this bearish daily order block, then you can look for potential levels where price could bounce to the downside, making a retracement on lower time frames. So only if price is near a key higher time frame level, then look for them. I personally like to do a top-down analysis, looking for higher time frame levels and mark them all relative to where is price now. If price on the monthly chart is inside of this range from this high to this low, then I will probably mark every level that I see inside of this range relative to where price is now and where is price coming from.
Si te gustan mis videos, suscríbete y dale like, que subo video todas las semanas y tu cuenta te lo va a agradecer.
Another common mistake smart money traders do is trying to refine the order block as much as possible to get the highest RR. But that's not the key for the high RR. The key is waiting for lower time frames break or market structures that are going to create a new institutional order flow on that lower time frame structure that is going to give you a new point of interest to base your setup from. So let me explain to you a little bit about this. So looking at this EURUSD chart, we are currently on the 4-hour chart. We can clearly see that we have an order block here, right? So what do most traders do? So they go into lower time frames, now to a 1 hour, and they're going to look for another order block. And now they're going to refine it to the lowest one, right? So now they go to the 30-minute chart and they do the same. We have another order block here, but now it started to look very confusing because we have this order block, but at the same time we have a long week. So they're going to start marking different levels. Then they go to a 5-minute chart maybe, and they see now more mess. They're going to see multiple order blocks, one order block here, another order block here, another order block here. They're going to have multiple levels. And if we take into account the liquidity voids or imbalances, you're going to have even more order blocks. You have one order block here, another order block here, and this order block here. And if we go on the 1-minute chart, and I have seen this many times where people start diving into lower and lower time frame non-stop, and even lower time frames, they're going to start seeing something like this. Okay, let's select all the order blocks or all the levels where I can get a massive snipe and be millionaire in one trade. Okay, let's do that. We have one order block here. We have another void with order block here, another void with order block, void with order block, void with order block, void with order block, void with order block. And you can see you are going to start having multiple levels where price might bounce off. Of course, there are some rules and some guidelines to follow in order to successfully select a level that is more likely to bounce from. But the overall idea is the following. Focus on the main order block where smart money has actually accumulated orders. You can see on this move to the downside, price grabbed liquidity below all these equal lows and then pushed higher, meaning that in this move, you're going to have smart money shorting and longing at the same time. So this is the main order block. Simply wait for price to get to that order block. You can see it did that several times. And of course, if you know some things about voids and how they mitigate the orders, you're going to end up looking at the level, for example, 50% of this void that we have here, as your main point of interest. And if you know Wyckoff, you will know that this was an accumulation broken and never tested. So this on the lower time frames is an unmitigated level. Again, price hitting your point of interest, you wait for a break on market structure. After the break, you can see we have, even on the 50-minute chart, break on market structure here. Price came back to the new created order block, which in this case is this candle right here. And you can simply trade based on this little candle right here. It's not going to be the best RR in the world, but you can see it's more than enough to make a lot of money, pass a lot of challenges if you want, and you don't need to overcomplicate looking for lower time frame refinements. Of course, we can go into the 5-second chart here and get an entry that will give you 100 RR, but that will require a lot of concentration and a lot of stress and a lot of stop losses, because you're going to get a lot of fakes, breakouts on lower and lower and lower time frames. It can all be improved. You can always refine your entries, but don't get crazy by trying to find the best order block possible where price is likely to bounce off, because there are going to be multiple levels and you're going to lose your mind. So there is no need to do that. Wait for price to get to your level, wait for a lower time frame confirmation, and then follow the order flow. Now, what do most traders do when they first learn smart money? They're going to watch some videos, learn a little bit about smart money. They're going to be amazed because, oh, now we know actually how the price moves. Let's look for some order blocks. And what happens? You're going to try to trade live all these concepts and you're going to blow your account in one day probably. So what's the lesson about this? Obviously, first, don't rush on anything. Back testing is going to save your life. Back testing is the key for you to learn. Don't jump to the swimming pool if you don't know how to swim first. This is extremely important. Go back testing. You're going to find out a new world of opportunities when you start back testing. You're going to find what are your mistakes, what you're doing wrong, what you should be doing to improve. You're going to start annotating all those tips in a paper, in your journal, in any place you want, and that's going to improve your trading drastically. And once you are profitable on backtesting, you can only then go into demo, and once you are proven being profitable on demo, then you can jump into live trading. This should be a boring business. If you're happy when you make a good trade, that's wrong. If you're sad when you lose money, that's wrong as well. You shouldn't be having any kind of emotions when trading or when backtesting. This is going to save you from a lot of mistakes and a lot of wasted time and money. Another common mistake most traders do is not being patient. They select a level, they do their analysis. Let's say that we are watching again at this same example on EURUSD. We're watching a downtrend being developed, and then we have a clear break of market structure here. Beautiful. Now that we have a clear break of market structure, you select your point of interest. In this case, let's say that this is all this order block that we have here. But of course, we don't want to take a trade based on this entire area because our stop loss will be very big. So we wait patiently. And what happens? Okay, let's do some replay mode to understand what is the thought process of most people when they are looking at this. You say, okay, I want to take a trade here. I have a little boy here. So if price gets to this level, I will take a trade. And what happens? Boom, 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 boom. Price starts moving to your level. You have a break of market structure here again, but nothing crazy because this break of market structure just happened. It's new. For now, you're waiting. So what happened? Boom, boom, boom. Price starts moving to your level. You say, oh, okay, nice. Price is coming into my level, but I want to take a trade based on here because this is a liquidity void that I know the algorithm needs to come back and rebalance it. So all good, are going to wait. You wait patiently, and what do you see here? Oh, price is coming again to my level. Are these equal lows? Yeah, they are equal low, but we have a tiny stop hand. I should be looking for a trade now because it has been a few hours since the break of market structure happened and I'm not getting into a trade. I'm getting impatient. I want to be on a trade. What's happening here? Again, price is coming to my level. No, I know some money. These are equal lows. These are equal lows. I'm not going to take a trade. Oh, why is price breaking to the upside? I'm not in the trade. Oh no, I'm missing the trade. No. This cannot happen. This is a break of market structure right here. Boom, boom, boom. And I'm going to take a trade here. Okay, we have an order block here. I don't want to miss a trade. It's been like 6 hours since this break happened and I'm not in a trade, so I'm going to take a trade right here. Let's take a trade, stop loss there. I don't care of the equal lows because now I'm being impatient. I fear of missing out the trade, and what happens? You get super wrecked, as you can see here. And this is happening because of not waiting for your level that you did analyze very well to get hit. If you waited patiently enough, you could have prevented yourself of making a mistake. If you have a clear analysis, wait for price to hit that level, because if you're wrong, you're going to miss a trade. That's okay. But if you're right, you're going to have a nice trade following your own analysis. Don't rush into a trade. Wait patiently for price to hit your level. If you don't want to continuously look at the screen waiting for price to hit your level, you can simply add an alarm on TradingView. You, for example, create a trend line like this, right click, add an alert on trend line. Oh, on replay mode, I cannot do it. You can set if that alarm is going to send you an email, show you a pop-up in your smartphone or whatever you like. So don't rush into a trade. The only thing that does to your account is give you a lot of stop losses. To finish this video, I'm going to talk about another very common error I see on most smart money traders. When they are looking at the chart, for example, they start looking at the 5-minute chart, and that's the only thing they do. They try to look for structures in this time frame without caring what price is actually doing. So have a plan on how to approach the chart. For example, what do? I always start on the monthly chart to know exactly what is the current target for price action. For example, if we quickly analyze EURUSD, we are coming from breaking the structure on the highest time frame here. Price is coming to a discount level of this range and bouncing here, breaking the structure. If it is breaking the structure and price is coming from this accumulation, where is the next logical target for price on the monthly chart? This high here, because now price could potentially become bullish and start going higher to mitigate maybe this order block or even go higher. That is also possible. So my monthly target is going to be this one. Then I go to the weekly chart. We have another weekly structure here. As you can see, price has been putting higher highs, higher lows, higher high, higher lows. That means that smart money has been accumulating, reaccumulating, pushing price higher, internal liquidity to external liquidity into internal liquidity, and now potentially to external liquidity. That means that as long as this low isn't broken, the target for this weekly chart is going to be this high, because price has been on a bullish move. On the weekly chart, I'm stuck in this range from this high to this low. Now on the daily chart, we are on a downtrend here. We can clearly see price has been put in a series of lower lows, lower highs, lower lows, tiny little stop handle, but price failing to break this last lower high, lower low, lower high, lower low. So that means that inside of the bullish week, we are now on a daily bearish trend. So as long as this level isn't broken, price on the daily chart is going to remain being bearish, meaning that a key level to look for potential longs and a key level to see price reacting off is going to be this level, where lastly on the weekly chart we saw price moving forward. So now on the daily chart we are stuck in this range from this high to this low. Now on this daily trend, as we are bearish, I expect price to come back into a level where smart money has distributed and maybe continue the downtrend. Take into account that we are coming from a bullish key level on the higher time frame. So in these situations, we're going to have a little bit sketchy decisions, because price could either respect this level and go lower, or simply break because we are coming from a higher time frame level. And that's when lower time frames, they're going to help you identify if smart money is actually accumulating or redistributing, if you know Wyckoff. So you can see how we can build different stories, knowing exactly what to expect depending on which time frame we are looking at. But if you don't know all this previous story and you simply start from the 5-minute chart, you're going to get lost very quickly.